study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole load. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me. Come study with me. Come and study with me. Come and study with me. Come and study with me. Put your name on top, put your name on top. This is your season. This is your season. Yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal, what is yours? Open that door, unlock more. Yes, you can do it, yes you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me. Come study with me. Come and study with me. Come and study with me. Come and study with me. Put your name on top. Put your name on top. This is your season. This is your season.
Right now, as most people are sleeping, scrolling, wasting time, or making excuses, you are here, building your future. Every page you read, every note you take, every hour you study is a brick that you're placing on the foundation of your success. Success is not magical. Success is repetition. It is discipline. It is showing up even when you're tired. There will be a moment you feel overwhelmed. There will be a moment in which you want to quit. But remember this. Your success in life does not depend on your ability to never fall, but your success in life depends on your courage to keep going. Because there will be a moment you will separate yourself from the people who quit because you decided to keep going. This is the moment to get into our study session. It's gonna be a few hours, so grab your books, grab your pen, your notebook, whatever you use to study, and let's go ahead, let's make it happen. Again, my name is Wilkin, and this is my study session, and I invite you to come and study with me. It's time to work. I'll see you in a few minutes. reduced equity, so subtract 1,250. Final answer 38,750. Okay. I'm working with non-controlling. The end. The question is talking about non-controlling interest. So why do I have common stock, retained earnings? So what are the thoughts behind these numbers? I have common stock 100,000 for Pairco and 50,000 for Kidco. Retained earnings 200,000 for Pairco and Kidco is 70,000. So what do I think about these numbers as I see them? This is exactly the right question. Okay. Common stock 100,000. Okay. This is the ownership section of each company. That's all equity. What is common stock? Think of common stock as money invested by owners. So Pair shareholders originally invested 100,000. Kid shareholders originally invested 50,000. This permanent owner investment is usually does not change much. Step 2. What is retained earnings? Retained earnings is profit the company kept over time, not distributed, accumulated profit. So Pair has kept 200,000 of past profits. Kid has kept 70,000. Alright, step 3. What should your brain think in consolidation? The moment you see Pair owns 75,000 of Kid, your brain should say Pair controls Kid. I know. That means Kid's assets liability become part of the consolidated company, but Kid's equity accounts are eliminated. What eliminate Kid's equity? Because from the group perspective, Pair cannot own itself. I understand that. The consolidated statements treat the parent subsidiary as one company. Alright. So what I'm really asking is, all of these are the numbers that I have. How do I focus on the right answer? Because the question asks what amount should be reported as non-controlling interest in Kid on Pair's December 31st year 1 consolidated balance sheet. So how do I ignore numbers and work with the right numbers that have been given to me? Can you identify the concept? Can you filter irrelevant information? Read only the question first. Before touching numbers, read what amount should be reported as non-controlling interest. Immediately your brain should activate non-controlling interest formula. In the non-controlling interest equals beginning non-controlling interest plus non-controlling. Okay. Okay, I'm missing part of the formula. Ending NCI, ending non-controlling interest equals beginning non-controlling interest plus non-controlling interest. There is something else I cannot see. That middle piece. Beginning. put it in small letters so we can fit in the screen on the screen. Still. It is still not fitting this on the screen. Put it vertically. Okay. Alright, so ending non-controlling interest equals beginning non-controlling interest plus non-controlling interest percent times sub net income minus non-controlling interest percent times sub dividend. What? Okay. I gotta write this down. Take this down. While evenly. Okay, have a great day. While lockpot lambo. Lock the door, please. Okay, so here's what I have. Ending non-controlling interest equals beginning non-controlling interest plus non-controlling interest percent times sub net income minus non-controlling interest percent times sub DIV. Help me understand that. profit is 25,000 times 25%, which is 5,000. That profit belongs to them. So their ownership increases minus non-controlling interest percent times sub. This means subtract the outside owner's share of dividend. Okay. Why? Because dividends are money leaving the company. Dividends reduce equity. Example, kid pay dividend of $5,000. Outside owners get 25%. So 5,000 okay, so it's minus $1,250 that cash left the company. So their ownership decreases. The whole story, think of non-controlling interest like a mini retained earnings account for outside shareholders. They start with ownership, 35,000, then profits increase it, dividends decrease it, exactly like retained earnings. Visualize it like this: outside owners bucket, starting bucket 35,000 plus 5,000 minus 1,250, and then bucket 38,750. Makes sense? shipping, you spend the money anyway. So selling expense 1,100,000. 1,500,000. 1,550,000. 1,100,000. 1,500,000. 1,550,000. What is not already part in for part in 400,000 for seed selling expenses where so what's the problem here? We're including seeds in the inventory. So goods. So we're not talking about cost of goods sold. December 31st, year one half of these goods were included in seeds in ending inventory. Year one selling expenses were 400,000 for seed. 1,400,000. 1,500,000. Take this. Our selling expense include 50,000 in freight out cost for goods sold to seed. Let me see what you say. 1,450,000. Why 1,450,000? One parent company. Oh, okay, I understand that. Choice D. In this scenario, the combined selling expense total 1,500,000. Parts 1,100,000 plus seeds 1,400,000, of which 50,000 were incurred by part to facilitate the inventory sale by seed to unrelated customers. This 50,000 is an inventoriable cost added to inventory and is reflected in cost of goods sold. When seed sells the inventory to an unrelated customer, furthermore, because the 50,000 represents an intercompany transaction, it must be eliminated when preparing the consolidated financial statement. Therefore, consolidated selling expenses are 1,450,000. That should be total 64,000. That's what I would say. Generally, when one company directly or indirectly owns a majority greater than 50% of another company's subsidiary, outstanding voting stock, their financial statements must be consolidated. In consolidation, the financial statements are combined, and then eliminations for intercompany transactions are made to reflect the single economic entity, sales, loans, leases. In this scenario, accounts receivable total 90,000. Accounts receivable. Accounts receivable total 90,000. Difference represents the elimination of the intercompany receivable payable between par and shell. Without the elimination, consolidation balance sheet would not represent a thing. Okay, I understand. So when the question asked December 31st, what was the amount of shells payable to pair for intercompany sales? Payable. We're talking about account payable. Yeah, we're talking about account payable and account receivable. Accounts receivable 52,000, 38,078. There is a difference. Understand. Let's understand this a little bit. Let's make it much simpler. In this question, it's a simple question. What should guide my mind towards accounts receivable? Because here we have inventory, revenue, cost of goods sold. And when I looked at revenue, it was tempting to say that 400,000 plus 280,000 is to 680 minus 616. That would be 64,000. But why would I work instead with accounts receivable instead of revenues? The question question asking about. Here, shells payable to pair means shell owes money. Pair is supposed to receive money. What does consolidation help? Consolidation, intercompany balances are eliminated. Okay, pair account receivable plus shares minus intercompany transactions. Okay, I understand. That is balance sheet relationship, the deeper logic, revenue, activity during the year, income statement. Okay, makes sense. The question asks what was the amount of shells payable to pair? So your brain should go directly to accounts receivable, accounts payable, not revenue. On December 31st, year one, Saks Corporation was acquired by Pool Corporation. In the business combination, Pool issued 200,000 shares of its $10 par common stock with a market price of $18 a share. For all of Saks's common stock, the stockholders' equity section of each company's balance sheet immediately before the combination is provided below. Common stock 3 million. Additional paid-in capital retained earnings. In December 31st, year one consolidated balance sheet, additional paid-in capital should be reported at what? Consolidated balance sheet. Additional paid-in capital should be reported. Additional paid-in capital. That's what we're working with. Okay. Additional paid-in capital. We have Saks. 1.3 million. 150,000. So 1.450. Here we have 1.450. But what's the scenario? December 31st, year one, Saks Corporation was acquired by Pool Corporation. In the business combination, Pool issued 200,000 shares of its $10 par common stock with a market price of $18 a share. For all of Saks's common stock. Okay. The stockholders' equity section of each company balance sheet immediately before the combination is provided below. So in December, additional paid-in capital should be reported at December 31st, year one. December 31st, year one, Saks Corporation was acquired. So, okay. Additional paid-in capital earns money that. Okay, let's see. Additional paid-in capital was 1.3 million for Pool's for Pool for the consideration transferred by the acquirer is measured at its fair value. Consolidated financial statements present the entities under common control as if they were a single economic entity. In consolidation, all intercompany transactions and the subsidiary equity are eliminated. Therefore, the consolidated equity represents the equity of the parent. Okay. In this case, both corporation acquirer and parent issued 200,000 shares of its own stock to acquire Sachs Corporation, acquiree and subsidiary, for 3,600,000. Okay. The par value of the shares issued is 2,200,000 shares times 2. And additional paid-in capital is 1,600,000. Although the consolidated total equity is 10,400,000, the consolidated additional paid-in capital is 2,900,000. Consolidated additional paid-in capital represents post beginning balance of 1,300,000 plus 1,600,000 recorded from the acquisition entry. Okay. So that's gonna be 2,900,000. I need to understand that better. In a business combination, the consideration transferred by the acquirer is measured at fair market value. So when we say fair market value, that's put issued 200,000 shares of its $10 par common stock with a market price of $18 a share. So the calculation will be done with 200,000 times 18. 200,000 times 18. $3,600,000. Okay. So yeah, the par value of the shares issued is 2 million. Yeah. And additional paid-in capital is 1,600,000. Yes. Okay. Although the consolidated total equity is 10 million, the consolidated additional paid-in capital is 2 million. 1,600,000 plus 1,300,000 plus 1,600,000. Why 1 million? Additional paid-in capital. Yes. So okay, got it. $15. So we still have the same $3,600,000 here for all of Sax's common stock. Okay, 3,600,000. The stockholders' equity section. Stockholders' equity section of each. And before the combination is this. Before the combination. Now after the combination, what is it gonna be? Let me see what it says. 5 million. When a company, the acquirer, purchases or controlling financial interest greater than 50% in another entity, the acquiree, the resultant business combination is viewed as single economic entity. To prepare consolidated financial statements, the separate trial balance of the acquirer and acquiree are combined. Equity reported on consolidated financial statements is always equal to the acquirer's equity and any non-controlling interest, including any stock issued by the acquirer for the purchase transaction. The All right, buddy, it's gonna be time. It's gonna be time for us to take a break. So in about 30 seconds, the timer is gonna change. The scene is gonna change to our break scene. So if you're here with me, you can just leave a comment. Let me know you're here so that I can acknowledge your presence with us in this study session. I'm not inviting you to come and see me study. I want you to also start to study something, go out there and start to work on yourself. All right. So we are on break right now. I'll see you in 10 minutes.
I want the whole load. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes, you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA. I see the fire, I hear you say, come study with me. Come study with me. Come and study with me. Come and study with me. Come study with me. Put your name on top. Put your name on top. This is your season. This is your season. Yeah. Library cards, fresh highlighters, head down, focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal. What is yours? Open that door, unlock more. Yes, you can do it, yes, you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me. Come study with me. Come and study with me. Come and study with me. Come and study with me. Put your name on top. Put your name on top. This is your season. This is your season. From the first page to the final light, I want your future to feel this bright. No wasted years, no empty pride. Just a bigger life on the other side. Come study with me. Come study with me. Come and study with me. Come study with me. Put your name on top. Put your name on top. This is your season. This is your season. This is my goal. What is yours? Come build that dream and open doors. Come study with me. Come study with me. Come study with me. Come and study with me. Yeah. Late nights, clean notes. I want the whole load. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes, you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA. I see the fire, I hear you say, come study with me. Come study with me. Come and study with me. Come and study with me. Come and study with me. Put your name on top. Put your name on top. This is your season. This is your season. Yeah. Library cards, fresh highlighters, head down, focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal. What is yours? Open that door, unlock more. Yes, you can do it, yes, you can. No more fear, just make the study with me. Come and study with me. Come and study with me. Put your name on top. Put your name on top. This is your season. This is your season. From the first page to the final light, I want your future to feel this bright. No wasted years, no empty pride, just a bigger life on the other side. Come study with me. Come study with me. Come and study with me. Come study with me. Put your name on top. Put your name on top. This is your season. This is your season. This is my goal. What is yours? Come build that dream and open doors. Come study with me. Come study with me. Come study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole load. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me. Come study with me. Come and study with me. Come and study with me. Come and study with me. Put your name on top. Put your name on top. This is your season. This is your season. Yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal, what is yours? Open that door, unlock more. Yes, you can do it, yes you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me. Come study with me. Come and study with me. Come and study with me. Come and study with me. Put your name on top. Put your name on top. This is your season. This is your season. From the first page to the final light, I want your future to feel this bright. No wasted years, no empty pride, just a bigger life on the other side. Come study with me. Come and study with me. Come and study with me. Come study with me. Put your name on top. Put your name on top. This is your season. This is your season. This is my goal. What is yours? Come build that dream and open doors. Come study with me. Come study with me. Come study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole load. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me. Come study with me. Come and study with me. Come and study with me. Come and study with me. highlighters, head down, focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal, what is yours? Open that door, unlock more. Yes, you can do it, yes you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me, come study with me. Come and study with me, come and study with me. Come and study with me. Put your name on top, put your name on top. This is your season, this is your season. From the first page to the final light, I want your future to feel this bright. No wasted years, no empty pride, just a bigger life from the other side. Come study with me, come and study with me. Come and study with me, come study with me. Put your name on top, put your name on top. This is your season, this is your season. This is my goal, what is yours? Come build that dream and open doors. Come study with me. Come study with me.
We are back. We're back. That was a great break. I needed that. I haven't had breakfast, so I need to go get myself something, you know. I'm so hungry. Hopefully you also had a nice breakfast. Nice break. All right, so let's go ahead and continue with our study session. We're gonna go again for another hour and 10 minutes, and then we're gonna take another break. All right, so I had a nice break. Nice breaks. I was so hungry, so I needed to get something to eat. But we are back. We're back. All right, so let's go ahead and get back to study mode. All right, so let's get it done. scenario, we are not using the fair market value of $18 per share. We are only using the $10 per share value. Alright? So, and help me understand how to identify exactly what I'm working on when they ask the question. What goes into common stock after acquisition? And the answer only par value, not market value. Okay. What did Paul issue? The problem says 200,000 shares issued, $10 per share. 200,000, $10 per share. $18 is market value. Immediately separate these in your mind. Number $10, $18, meaning legal common stock amount, market fair value of shares issued. Okay? Step 2. What does common stock represent? Common stock records only par value. It does not record market value. So when new shares are issued, common stock increases by shares issued times par value, not market value. Okay. Not market value. Okay. Calculation 200. Okay. 2 million. That is the increase to common stock. And where does the rest go? The market value was 18, 2 million, 1.6. That goes to additional paid in capital thing. I understand that. Okay. How do I know what number to use? Look at what account the question asked for. If the question asked for common stock, your brain should think par value only. If the question asked for acquisition value, purchase price, consideration transferred, investment amount, goodwill, then use fair market value because acquisitions are recorded at fair market value. Okay. Take some notes. Okay. Question asks for common stock, par value, additional paid in capital, excess over par, purchase price, fair market value, goodwill, fair. Okay, that's good. Okay. Consolidation. purchase price, fair value, goodwill, fair value, consideration transferred, fair value. Okay. Since common stock is ignored, this is another huge consolidation. After acquisition, subsidiary equity accounts disappear in consolidation. After acquisition, subsidiary equity accounts disappear. The subsidiary subsidiaries equity accounts equity account disappear. In consolidation. When you see consolidated common stock, your brain should immediately say parent company common stock only. When you see consolidated common stock, see consolidated common stock. Keep pairing common stock. Add new shares issued at par. Add new shares. New shares. Issued at par. Ignore subsidiary equity accounts. Equity accounts. Okay, that's good. Okay. Tulip Co. owns 100% of Daisy Co.'s outstanding common stock. Tulip's cost of goods sold for the year totals $600,000, and Daisy's cost of goods sold totals $400,000. During the year, Tulip sold inventory costing $60,000 to Daisy for $100,000. By the end of the year, all transferred inventory was sold to third parties. Good amount should be reported as cost of goods sold in the consolidated statement of income. Alright, so it's 100% ownership. 100% ownership. To the cost of goods sold for the year total $600,000. Okay, Daisy's cost of goods sold total $400,000. Okay. During the year, Tulip sold inventory costing $60,000 to Daisy for just incorrectly reporting that $100,000. So we're gonna say minus 100,000. So that will make it 900,000. But now Tulip sold inventory costing 60,000 to Daisy. That's $60,000. It cost Tulip $60,000. But Tulip cost of goods sold for the year total 600,000. So that means that $60,000 is already in the total of 60,000. That's what I would say. So I'll say 900,000, because removing the $100,000 here. Yeah, makes sense. Okay. Part acquired its interest in spin on January 2nd, year 1. During year 1, Part sold goods to spin at the same markup on cost that Part uses for all sales. At December 31st, year 1, Spin had not paid for all of these goods and still held 37.5 of them in inventory. Balance sheet accounts receivable, inventory, non-controlling interest, stockholders' equity. What was the amount of intercompany sales from Part to Spin during the year? What was the amount of intercompany sales? So if we're talking about sales, accounts receivable, no, inventory, non-controlling interest, stockholders' equity, revenue, cost of goods sold, gross profit, net income. What was the amount of intercompany sales? So if we're talking about sales, we need to go to revenue. So 200,000 plus 140,000, that's 340,000. Minus 308,000. That would be 32. 340,000 minus 308,000. That's not 32. What am I saying? Yeah, that would be 340,000. What? Let me do that. 340 minus 308. Yes, that's $32,000. That's what I would say. Okay, you're correct. On September 1st, year 1, Philips Inc. issued common stock in exchange for 20% of Sago Inc.'s outstanding common stock. On July 1st, year 2, Philips issued common stock for an additional 75% of Sago's outstanding common stock. Sago continues in existence as Philips' subsidiary. How much of Sago's year 2 net income should be reported as accruing to Philips? All right, so this is logic. So a lot of logic that you gotta think. This is logic. What is the question asking? September 1st, year 1, Philips Inc. issued common stock in exchange for 20% of Sago Inc.'s outstanding common stock. On July 1st, year 2, Philips issued common stock for an additional 75% of Sago's outstanding common stock. Common stock exchange of 20%. Okay, so September 1st, year 1, 20%. July 1st, year 2, additional 75%. That makes it what? 75, 85, 95 of Sago's outstanding common stock. Sago continues in existence as Philips' subsidiary. How much of Sago's year 2 net income should be reported as accruing to Philips? Sago's net income. Well, talking about net income, it's gonna be 95%. 95%. If we were talking about asset, they would control 100% of the asset, but they don't receive 100% of the net income. How much of Sago's year 2 net income should be reported as accruing to Philip? So Philip Inc. issued common stock in exchange for 20% of Sago's. I understand the concept, I just didn't read everything. Yes. Parker Corp. owns 80% of Smith Inc.'s common stock. During year 1, Parker sold Smith $250,000 of inventory on the same terms as sales made to third parties. Smith sold all of the inventory purchased from Parker in year 1. The following information pertains to Parker's cost of goods sold for year 1. Parker $400,000, Smith $350. What is Parker's consolidated cost of goods sold for year 1? Are we going to consolidate cost of goods sold? Because here we have $750. I would say it's 750. Okay. During year one, Parker sold Smith $250,000 of inventory on the same terms as sales made to third parties. Okay. Parker Corp 400, Smith 350, 750. Sold Smith 250,000 of inventory. You cannot calculate that. 250. Wait. 750 minus 250. It's 500. So here you have 400. Take 250 out of 350. Alright, so you take 250 out of the 350. Makes you 500,000. It's simple. A U.S. company owns 80% of a non-U.S. company located in a foreign country with a very unstable political and economic climate. In which of the following situations should the U.S. company not consolidate its financial statements with the non-U.S. company? Foreign country has currency exchange rate fluctuation on a daily basis. The government of the foreign country has increased the tax rate for all companies that are majority owned by U.S. companies. The government of the foreign country had required all companies operating within its borders to implement the international financial reporting standards. The government of the foreign country has recently imposed a number of severe sanctions and controls on all companies that are majority owned by the U.S. company. Yes, this one. When the government controls the company, when the company is in bankruptcy, in these situations, you should not consolidate. Let me see what situations. Investee opposes regardless of ownership percentage. Investee opposes investment. Significant influence is exercised by shareholders other than the investor. Investee is in bankruptcy or legal consolidated financial reporting is required. The combined company is viewed as a single economic entity because the parent controls the subsidiary resources and financial decisions. However, regardless of ownership percentage, there are situations in which the parent does not or cannot control the subsidiary and therefore should not present consolidated financial statement. For example, if a foreign subsidiary operates under severe government restrictions, alright, things to remember. Consolidated financial statements are typically required when a parent owns a controlling financial interest. Okay, makes sense? But take some notes. Investee opposes circumstances where an investor does not have significant influence regardless of ownership percentage. Investee opposes investment. Investee opposes investment. Significant influence is exercised. Is exercised by shareholders. Shareholders other than the investor. regulated entity that operates under foreign government. Under foreign government restrictions. That preclude investors. Restrictions that preclude. Exercise of significant influence. Of significant influence. Investor cannot obtain representation. Investor cannot obtain representation. On the investee's board of directors. one would not affect, I think, the goodwill. And that's something we need to learn, whether the parent uses cost method or equity method to account for its investment in the subsidiary. Okay. Oh, whether the parent uses the cost method or equity method to account for its investment in the subsidiary. That should not affect it. Whether the business combination resulted in goodwill. Let's read that. When a company owns a controlling interest in another business, it must consolidate its subsidiary financial statement. This produces a single consolidated set of statements for the entire accounting entity. To create a consolidated financial statement, the parent investment in the subsidiary and the subsidiary's equity are eliminated. If the parent owns less than 100% of the subsidiary, then the non-controlling interest is recognized during the consolidation process. However, the investment is initially recorded at cost under both methods, so the elimination entry immediately after the acquisition, before any activity occurs, is the same under both methods. As part of the consolidation process, intercompany transactions and balances are eliminated because they have the potential to distort the overall financial statement result. Whether the business combination result in goodwill, whether the parent uses, or I need a little more explanation of this. Whether the intercompany payable exists. Give me an explanation of each option and why it would or would not affect a parent's adjustment entries to prepare a consolidated balance sheet. What changes consolidation entries? Adjusting entries to prepare a consolidated balance sheet. So think what things would change the elimination consolidation entries. Now let's analyze this. Whether intercompany payable existed. Yes, this affects consolidation entries. Why? Because intercompany balances must be eliminated. If parent owes subsidiary, account payable must be removed. Accounts receivable must be removed. Okay. Whether the business combination resulted in goodwill, that affects it. It says yes, this affects consolidation entries. If purchase price exceeds fair value of net identifiable asset. Whether the parent uses the cost method or equity method, this does not affect consolidation entries. This is, why? Because consolidation ultimately converts everything to as if one company exists. Whether the parent internally used cost method or equity method, the consolidation process fixes it. Okay. A Corp owns 100% of B Corp, and B Corp and C Corp. B sells merchandise exclusively to C, and C sells exclusively to external customers. I is a holding company with no income of its own. B and C have the following information for year one: sales, 130,000, 91,000. Cost of sales, 100,000, 65,000. Beginning inventory 0, ending inventory 65,000. What amount should be reported as gross profit in the consolidated income statement for the year ended December 31st, year one? What amount should be reported as gross profit in the consolidated income statement for the year ended December 31st, year one? Gross profit. Cost of sales 100,000, 65,000. That should be simple. Sales 130,000, 91,000. Cost of sales. What amount should be reported at gross profit? Gross profit. Sales. Alright? But what will be 130,000 plus 91,000? Ending inventory 65,000. Cost of sales. So now, what is gross profit? Gross profit is when you have not removed the cost. Let's see something. Well, the question asks what amount should be reported as gross profit in the consolidated income statement for the year ended December 31st, year one. So I'm looking at sales, $130,000 and 91,000. Yeah, so help me understand that. Good. Alright, so gross profit. Immediately your brain should say gross profit equals sales minus cost of sales. That is the core formula. Okay, step one, combine the company's first sales 130 plus 221. Cost of sales 100,000 plus 65,000, 165. At first glance, 221 minus 165. But consolidation questions are never that easy. Now your brain should ask, are there any other intercompany sales? The clue, the problem says sold exclusively to external customers. That sentence is huge. It means no intercompany sales exist. So no sales elimination, no unrealized profit elimination, no inventory adjustment. Why did they give inventory numbers then? To tempt you. CPA questions often include extra inventory balances, extra beginning inventory, extra ending inventory to make you think unrealized inventory profit, upstream, downstream inventory elimination, but a phrase sold exclusively to external customers kills all of that. So the inventory becomes irrelevant because no intercompany inventory exists. All sales were external. 56. Okay. But something else. B sells merchandise exclusively to C, and C sells exclusively to external customers. So how should I interpret that part where it says that B sells merchandise exclusively to C and C sells exclusively to external customers? I understand sells exclusively to external customers, so there is no intercompany sales in this case. But what about B sells merchandise exclusively to C? How do we interpret that? B sells merchandise exclusively to C. Then there are intercompany sales. That changes everything. Then the second sentence, C sells exclusively to external customers, becomes the key to solving the problem. Let's interpret the story carefully. B sells to C. This is intercompany sales, yes, inside the consolidated group. From the consolidated perspective, the group cannot sell to itself. So those sales must be eliminated. Then C sells to external customers. This means eventually the inventory left the consolidated group. So the profit became realized. Why is that important? Because consolidation only defers profit when inventory is still inside the group at year end. But here, C sold inventory externally, so no unrealized profit remains. The inventory clue confirms it. B ending inventory is 0. Beginning inventory is 0, ending inventory is 0. Ending inventory is 0, ending inventory is 65. C Something is not clicking here. It's 41,000. Transactions between related and to get water. Unrelated companies, consolidated group parent company. Intercompany transactions eliminated in consolidation. Subsidiary company. Subsidiary. Okay, cool. So intercompany transactions eliminated in consolidation. I need to come back to this. Wagner, a holder of 1 million Palmer, 1 million of a 1 million Palmer Inc. bond, collected the interest too, and then sold the bond to Seal Inc. for $975,000. On that date, Palmer, the 100% owner of Seal, had a $1,075,000 carrying amount for this bond. What is the gain recognized on this transaction for the consolidated group? Wait, Wagner, a holder of a 1 million Palmer Inc. bond, collected the interest too, and then sold the bond to Seal Inc. for $975,000. On that day, Palmer, the 100% owner of Seal.
Come study with me.
All right, everybody, it's time to go to break.
Come study
It's time for break. We'll be back again in 10 minutes.
Come
So go ahead and take a break. Enjoy your break. Get something to eat. Drink some water, and then we'll be back. Deep focus. We're gonna make it. All right.
Hold up. Go pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes, you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA. I see the fire, I hear you say, come study with me. Come study with me. Come and study with me. Come and study with me. Come and study with me. Put your name on top, put your name on top. This is your season. This is your season. Yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA. That's the climb, that's the way. This is my goal. What is yours? Open that door, unlock more. Yes, you can do it, yes, you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me. Come study with me. Come and study with me. Come and study with me. Come and study with me. Put your name on top. Put your name on top. This is your season. This is your season. From the first page to the final light, I want your future to feel this bright. No wasted years, no empty pride. Just a bigger life on the other side. Come study with me. Come and study with me. Come and study with me. Come study with me. Put your name on top. Put your name on top. This is your season. This is your season. study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole load. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me, come study with me. Come and study with me, come and study with me, come and study with me. Put your name on top, put your name on top. This is your season, this is your season. Yeah, yeah, yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal, what is yours? Open that door, unlock more. Yes, you can do it, yes you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me, come study with me. Come and study with me, come and study with me, come and study with me. Put your name on top, put your name on top. This is your season, this is your season. From the first page to the final light, I want your future to feel this bright. No wasted years, no empty pride, just a bigger life from the other side. Come study with me, come study with me, come and study with me, come study with me. Put your name on top, put your name on top. This is your season, this is your season. This is my goal, what is yours? Come build that dream and open doors. Come study with me. Come study with me. Come study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole load. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me, come study with me. Come and study with me, come and study with me, come and study with me. Put your name on top, put your name on top. This is your season, this is your season. Yeah, yeah, yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal, what is yours? Open that door, unlock more. Yes, you can do it, yes you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me, come study with me. Come and study with me, come and study with me, come and study with me. Put your name on top, put your name on top. This is your season, this is your season. From the first page to the final light, I want your future to feel this bright. No wasted years, no empty pride, just a bigger life from the other side. Come study with me, come and study with me, come and study with me, come study with me. study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole load. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me. Come study with me. Come and study with me. Come and study with me. Come study with me. Put your name on top, put your name on top. This is your season. This is your season. Yeah, yeah, yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal, what is yours? Open that door, unlock more. Yes, you can do it, yes you can. No more fear, just make the plan. Put some credential by.
We are back. We're back. That was a great break. All right, so we're going to go back, right back into our study session. That's going to be our last session, last hour session. So get ready. All right, get your book, your notebook, your pen, pencil, whatever you need to study. And let's get it going. All right, thank you very much. I'll see you in a minute. We are back from break, so let's get ready to get back to our deep focus. All right, get your book, your notebook, your pen, your pencil, whatever you use to study. And let's get this, let's flip some pages. All right. All right, so we'll talk in a minute. This is our last session for the day. And let's get it going. Okay. Wagner, a holder of 1 million Palmer Ink bond, collected the interest to and sold the bond to Seal Ink for $925,000. a way that is really simple to understand. Why is it $100,000? It's not zero. From the consolidated perspective, the bond is not retired. That is why gain is not zero. The bond is not retired. Okay, slow the story down. Step 1, Palmer issued the bond. Palmer owes 1 million. Okay, to who? This is debt. This is debt. Step 2, Wagner owned the bond. Wagner is outside the consolidated group. So from the group perspective, Palmer, debtor, Wagner, outside creditor. No more external debt. Yes. Step 3, Wagner sells the bond to Seal. Seal is owned by Palmer. Wagner hold Palmer. Wagner owned Palmer. Palmer owns Seal. Okay. The consolidated group now owes money to itself. Consolidation and interpretation. When the company buys back its own debt, debt is considered extinguished. Retired. What matters for gain or loss? Carrying amount of debt, $1,075,000. Repurchase price, $975,000. Think like this. Palmer's book says, I still owe $1,075,000, but the consolidated group only paid $975,000 to get rid of the debt. So the group saved $1,075,000, saved $100,000. That savings is gain on extinguishment of debt. Why not zero? This is the key misunderstanding. You thought because it's intercompany eliminate everything, but consolidation does not ignore economic reality. The group actually eliminated a liability for less than carrying value. That creates real economic gain. Simple real life analogy. Imagine you owe the bank $1,075,000. Then somehow your company buys that debt for $975,000. Effectively, debt disappears. You paid less than what you owed. You benefited by $100,000. That benefit is gain. Okay. So if you owe the bank what are the possibilities of buying a debt for less? Let's say I owe the bank $100,000. What are the possibilities for my company to buy this loan for $80,000, for example? But for less than the amount owed when the debt is worth less than its face or carrying amount. Here are the main ways it happened. Interest rates change. This is the most common reason. Suppose you borrowed $100,000 at 3%. Later, market rates rise to 8%. Now your old bond paying 3% is unattractive. Investors will not pay full price for it. So the debt may trade for $80,000 even though you will legally owe $100,000. Why? Because the bond's interest payments are weak compared to newer investments. Financial trouble, risk of default. If investors fear bankruptcy, late payments, default, the debt price drops. Example, you owe 100,000, but investors think there is a chance we may only recover 80%. So the debt trades around $80,000. The economic change, sometimes recessions. Okay, I understand that. On January 1st, year one, purchased all of Scott's common stock for $360,000. On January 1st, year one, the fair value of Scott's asset and liabilities equaled their carrying amount of $410,000 and $160,000, respectively. The fair value of Scott's inventory was $10,000 more than its carrying amount on the acquisition date. Paris policy is to amortize intangible asset over a 10-year period unless a definite life is ascertainable. During year one, Pearl and Scott paid cash dividends of $100,000 and $30,000 respectively. There were no intercompany transactions except for Pearl's receipt of dividends from Scott and Pearl's recording of its share of Scott's earnings. December 31st, year one, selected information. December 31st, year one, selected information. Investment in Scott equity method. Retained earnings. Scott common stock. What's the question? In the December 31st, year one, consolidated balance sheet, total retained earnings should be. Alright, here we're talking about retained earnings. 755 to 30. So we're talking about 755 retained earnings. Purchased all of Scott's common stock, 360. Generated the fair value of Scott's assets and liabilities is equal the carrying amount, 410 and 160 respectively. The fair value of Scott's inventory was $10,000. million has got 230. Fair value of Scott inventory was $10,000 more than his carrying amount and the acquisition date. Per's policy is to amortize intangible assets over a 10-year period unless a definite life is ascertained. Pearl and Scott paid cash dividend of $100,000 and $30,000. Okay. So I think it will only be reduced by the dividend paid. Pearl and Scott, 130. There is no NCI non-controlling interest. All of them. Okay. So now what we say is 100,000, 755 minus 100,000, that's 655. 230 minus 30, that's 2. That's 200. So here we have 655,000 plus 200,000. Retained earnings. You do not consolidate retained earnings. You do not. So I was gonna say 655. Do we have Scott inventory? Because they're carrying amount for fair value of Scott's asset and liability equal there. Asset and liability. Asset 410,000, liability 160,000. 160 minus 410. $160 minus 410. No. 410 minus 150. 160. 250. 250. You pay dividend of 100,000. That's 150. 150 plus 755 minus 1 plus 755, that's 900. one entity parent obtains a controlling financial interest in another entity, the subsidiary consolidated financial reporting is required. The combined company is viewed as a single economic entity because all of its resources are controlled by the acquirer. Using the equity method, Scott's earnings and dividends during the year are reflected in the Pearl's investment account balance sheet, and equity earnings in subsidiary account income statement. Scott's dividends are recorded as a reduction in the investment account and do not impact Pearl's retained earnings. There are no controlling interest because I don't understand that, but 755. Wow. 755. Why would the answer be 755? I want a simple and short explanation for this. In a consolidated balance sheet, you keep only the parent's retained earnings. You do not add the subsidiary retained earnings. Okay. So Pearl retained earnings is 755,000. That is the starting point and the final answer. Why not Scott's retained earnings? Because Scott is subsidiary. Okay. The quick mental rule: consolidated retained earnings, parent retained earnings only. Another important thing, Pearl already used the equity method. That means Scott's earnings were already included in Pearl's retained earnings indirectly. Retain the parent's retained earnings. So what should we do with the asset and liability number? We have asset of what? During year one, paid in dividend, and then we have the dividend paid, which is 100,000. I know dividend paid would affect retained earnings anyway. So why we're not using any of these numbers? Because the question only asks for consolidated retained earnings. So you only use numbers that affect parent retained earnings at consolidation. Asset and liability fair values. The problem says asset 410, liability 160. These are used to calculate net identifiable asset. goodwill acquisition differential, but not consolidated retained earnings directly. So for this question, ignore them. Inventory fair value adjustment. Okay. Who's here studying with me? Nobody? No one is studying with me. There is no one studying with me today. All right, people. Get your things together. You know, we need to study. All right. I don't know who I'm talking to right now, and nobody's gonna watch this video after I'm done. Nobody's watching right now, but I think the air will bring it to somebody. All right, so the air is gonna bring what I'm saying here to someone. And if you watch this video anytime later, I know somebody's gonna come back. When they hear my story, they will come back to the channel to see what I was doing. And they would say, man, have I known that, I would have done the same thing. But I'm sorry, you're not here right now. Where are you? Right? Where are you? I'm here. And you're not finding me. I'm here. So it's time to study, okay? Let's go ahead and get your book. Anytime you're watching it, it's early, okay? That's okay if you're not watching it right now. There is a reason for that. You may be doing something else, that's fine. But if you're watching it now in 2050, if you're watching this video in 2050, it was meant for you to watch this video in 2050. If you're watching it in 2095, so we are in 2000 what? We're in 2026 right now. So if you're watching it in 2095, you were meant to watch this video in 2095. I don't know when you're gonna be watching it, but get to study, okay? All right, so let me get back to work. On November 30th, year one, Polar Inc. purchased for cash a $15 per share, 250 shares. The outstanding common stock of Shaw Co. at November 30th, year one. Shaw's balance sheet showed a carrying amount of net asset of $3 million. The Shaw's balance sheet showed a carrying amount of net asset of $3 million. At that date, the fair value of Shaw's property, plant, and equipment exceeded its carrying amount of $400,000, and the fair value of Shaw's trademark name brand is $75,000. So what amount should Pollard report as goodwill? How much did you purchase it for? Anyway, tell me how much you purchased it for. $15 times 250,000, 3,750,000. That's what you bought it for. Okay. 3,750,000. You bought it for that. At November 30th, year one, Shaw's balance sheet showed a carrying amount net asset of $3 million. At that date, the fair value of Shaw's property, plant, and equipment exceeded its carrying amount by $400,000. So it would be $3,400,000. $3,475,000. As goodwill. Goodwill. Okay. So the total, alright, 3,475,000. So that minus 3,475,000. 275,000. That's good. That's good. That's good. So it's 275,000. For purposes of consolidating financial interest, a majority voting interest is deemed to be. For purposes of consolidating financial interest, for purposes of consolidating financial interest, a majority voting interest is deemed to be with 50% of the directly or indirectly owned outstanding voting shares of another entity. 50% of the directly or indirectly owned outstanding voting shares, and at least 50% of the directly or indirectly owned outstanding non-voting shares of another entity. Greater than 50% of the directly or indirectly owned outstanding voting shares, and at least 50% of the directly or indirectly owned outstanding non-voting shares of another entity. What do you mean of another entity? Greater than 50% of the directly or indirectly owned outstanding voting shares of another entity. Okay? Greater than 50% of the directly or indirectly owned outstanding voting shares, and at least 50% of directly or indirectly owned outstanding non-voting shares. Well, voting shares and non-voting shares. Let's learn it once and for all, because I didn't know that deeper layer of it. The question is testing one core idea. What creates control? Ha! The answer is owns more than 50% of voting shares. So the correct answer is C. Got it. Why? Because voting shares give decision-making power, board control, operational control. That is what consolidation cares about. Important distinction: voting shares, control. Non-voting shares, ownership, economic interest only, not control. So non-voting shares do not determine consolidation. This is powerful. This is something I didn't know. Okay. And you should take some notes. Greater than 50% of directly or indirectly owned outstanding voting shares of another entity. Non-voting shares don't matter because there is no control. They don't provide any influence or control. Okay. We are getting there, my friend. Acquired its interest in Spain on January 2nd, year 1. During year 1, Part sold goods to Spain at the same markup on cost that Part uses for all sales at the January. Check payable, check receivable. Alright, accounts receivable 26 plus 19. Okay, so 45 minus 39. 6. And this question, even though they give you a lot of information, only one matters. That's good. That's good. On January 1st, year 6, Corp sold a machine for $900,000 to Saks Corp. Its wholly owned subsidiary, Poe paid $1,100,000 for this machine. Okay, $1,100,000, which had accumulated depreciation of $250,000. Poe estimated a $100,000 salvage value and depreciated the machine on the straight line method. January 1st, year 6, Poe sold machine for $900,000 to Saks Corp. What's the question? The book value of the machine should be reported as book value of the machine. That's what I'm looking for. Okay, on January 1st, year 6, Poe Corp sold a machine. $900,000 to Saks Corp. It's wholly owned subsidiary. Okay, you didn't sell it to nobody. Poe paid $1,100,000 for it. You cannot sell anything to yourself. So this is a fake profit. Alright, $200,000 fake profit for this machine, which had accumulated depreciation of $250,000. Okay. Poe estimated a $100,000 salvage value and depreciated the machine on the straight line method over 20 years. A policy that Saks continued. Okay. In post December 31st, year 6, consolidated balance sheet in the book of should be reported as the book value. Alright. The machine cost $900,000. There is a depreciation of $250,000. Over 20 years. This is $250,000 times 20. That's $5 million. It's $5 million. How could it be $5,250,000? Poe estimated $100,000 salvage value and took over 20. Over 20 years. Okay. So it has again a depreciation of $250,000. So we're in year 6 now. If we're in year 6, so you already got 1.5 million out of it. What? That doesn't make sense. $250,000. Let me do that. Accumulated 250. Alright, so 250 divided by 6. What? 250 divided by 6. 41. Alright, so $41,000. Let me do it for the whole thing. 250 divided by 6 years for 41,666. Okay. A year. Salvage value depreciation. Straight line 20 years policy. Total balance sheet. Okay. So you have 250,000 depreciation. Out of 900,000. That would be 650 plus 100,000. That would be 750. Paid 1.1 million for the machine. Okay. So a little deeper, little deeper, little deeper. Happy birthday to you. Happy birthday to you. Okay. We are getting there, my friend. We are getting there. Okay. January 1st, year 6. Okay, step 1, find original book value 1.1 million. Accumulated depreciation 250,000. So book value at sale date is 1.1 million. Why? 850. Step 2, ignore the intercompany selling price. Post sold it to say for 900,000, but consolidation says the group sold it to itself. So the gain is eliminated. Inflated asset value is eliminated. Consolidation, continued depreciation using original basis. Salvage value 100,000, useful life 20 years. Original depreciation base 1 million minus 1.1 million, 1 million. Annual depreciation 50,000. Determine current year depreciation. Accumulated depreciation before sale 250. That means 250,000 for 5 years. Now we're at year 6, it's 300,000. Consolidated net book value 1 million minus 1.1 million. So why would the book value be 1.1 million if they purchased the machine for 900,000? Original purchase price. But originally bought the machine for 1.1 million. That is original cost to consolidated group. 2 years of depreciation. Internal sale. Wait. Sold machine for 2.6. Oh. Who paid for this machine? I see. book value was $1.1 million minus depreciation, 300,000 because we're in year 6 right now. Okay, so to understand that, the book value of the machine, the original purchasing price is $1.1 million minus depreciation is up to year 6. All right, so it's $300,000 up to year 6. 1.1 million minus 300,000, so that's 800,000. Okay, that makes sense. January 1st, year 1, Pope Corp and Stress Corp had condensed balance sheet as follows. What's the question? January 2nd, year 1, Pope borrowed $60,000 and used the proceeds to purchase 90% of the outstanding common shares of Stress. This debt is payable in 10 equal annual principal payments plus interest beginning December 30th, year 1. The excess cost of the investment over Stras's book value of the acquired net asset should be allocated 60% to inventory and 40% to goodwill. Business combination, assets and liabilities of the acquiring subsidiary are purchased at fair market value on the acquisition date. The combined company is viewed as a single economic entity because all of its resources are controlled by the acquirer, by the parent. Consolidated financial reporting is required in all consolidations use the acquisition method. On the transaction date, fair market value of the acquiree's net identifiable assets needs to be calculated. Determine the book value of the net asset purchased and identify any non-controlling interest. Allocate consideration in excess of book value to identifiable asset or goodwill. Calculate the fair market value of identifiable asset and liabilities book value prior to the transaction plus any fair value adjustments created from the transaction. Jane Co. owns 90% of the common stock of Dunn Corp and 100% of the common stock of Beach Corp. On December 30th, Dunn and Beach each declared cash dividend of $100,000 for the current year. What is the total amount of dividends that should be reported in the December 31st consolidated financial statements of Jane and its subsidiaries Dunn and Beach? What is what? What is the total amount of dividend that should be reported in the December 31st consolidated financial statement of Jane and its subsidiaries Dunn and Beach? You only report the parent dividend. So here we go. Jane Co. owns 90% of common stock of Dunn Corp and 100% of the common stock of Beach Corp. On December 30th, Dunn and Beach each declared a cash dividend of $100,000 for current year. What is the total amount of dividend that should be reported in the December 31st? 100,000. $100,000. Report 100,000. You only report the parent company, Dunn and Beach. Jane Co. owns 90% of common stock of Dunn Corp and 100% common stock of Beach. This is a little complicated. I would say one, because the parent company has no dividend. What would say 0? Or well, I know you should only report the dividend of the parent company, but here the parent company doesn't have no dividend, doesn't have any dividend. So dividends pertain to the acquirees. So how do we work with that? Only dividends paid to outside owners remain in consolidation. Dunn dividends. Dunn declared 100,000. Jane owns 90%, so 90% is internal. 10% goes outside. Non-controlling interest, outside portion, 100%. I understand that. Okay. Beach dividend 100,000, but you own 100%, so it's gonna be zero remains. Total consolidated dividend. What? Okay. Beach dividend declared 100,000. Jane owned. All right, everybody. It's time. We have completed 3 long sessions with deep focus on what we want to accomplish. Man, isn't it great to spend time working on your goals and your dreams? You don't find that often. If it was not because of you and you're not here right now, if it was not because of you, I would not stay here on this video working on all these questions in the morning. I would get up, I would get some water, I would do other things, I would not focus. But because of you, I was able to focus to do the things that I want to do, to work on my goals and my dreams. And I'm hoping I'm doing the same for you too. All right. So thank you very much for spending the time with me today. Have a wonderful day and stay productive.
This is your season. This is your season. Yeah, yeah, yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal. What is yours? Open that door, unlock more. Yes, you can do it, yes, you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me, come study with me. Come and study with me, come and study with me. Come and study with me. Put your name on top, put your name on top. This is your season, this is your season. From the first page to the final light, I want your future to feel